We've got some numbers just out from Target. These are the numbers we were waiting for this morning. On the bottom line, the numbers are not good. You're going to be talking about earnings of $1.54. That is well below what the street was expecting. The street was looking for $2.13. Now, revenue did come in better than expected. It was $26.52 billion. The street was looking for $26.38 billion. Comp store sales were also better than expected. They were up by 2.7% versus the consensus estimate of 2.2%. But Target is talking about some very concerning trends that they have seen in the store. Starting in October, they just say basically the consumer changed drastically starting in October. I spoke with Brian Cornell yesterday, and he pointed out that in October, consumers were really starting to feel the pressure from inflation, and it showed up in the stores and what they were buying. Food and beverage was very strong. Things like beauty, very strong, but they saw weakness when it came to apparel, when it came to home, toys, and electronics. And that is definitely something that has impacted their margins as well. They have had to offer things on sale. Brian Cornell telling us that it's a situation where consumers are waiting to see a sale. When they do, they'll come in. They'll buy things like televisions and electronics, but that's obviously impacting their margins on this, too. Right now, things that you could see, Brian Cornell says this could be a much softer holiday season than we were anticipating. As a result, the company is actually lowering its top line and bottom line expectations for the fourth quarter. If you look at the numbers on this, they say that they are looking now for low single-digit decline in comp store sales. They say that's consistent with the recent trends that started at the beginning of October and I think got worse as the month moved on. The company's now also planning for a wide range for the fourth quarter operating margin centered around 3%. The company also says, Target says, that it's going to be taking an enterprise-wide effort to try and lower costs over the next 3 years. They think it can save a total of $2 to $3 billion over the next 3 years with that work. They said part of it's because the company's grown so rapidly during the pandemic, revenue up by 40% over that time period. So they think they can change things. When I spoke with Cornell about this, he said they're not planning on mass layoffs like you've seen with Target. They are not planning anything like that. He also said the benefits that they're offering of employees are not going to change. But take a look at the stock reaction. It is now down by about 13%. People had been anticipating that this was going to be the cleanup quarter, that they had gotten rid of a lot of the inventories, but it looks like the consumer has changed again.